Hi guys, welcome to Pristine Gaze, your go-to channel for in-depth stock analysis and financial insights. So today we'll be looking at In-House Systems Limited, which is a very promising dividend stock in my opinion, listed on the Toronto Stock Exchange. So In-House is essentially a enterprise software service provider which actually caters to a number of industries and operates through two primary segments, which is the interactive management group and its asset management group, and it offers a range of solutions ranging from customer communications, video software, and telecom services. And this company was actually founded in 1984, and it has primarily relied on its inorganic growth approach and its acquisition approach for its long-term operational expansion, which has actually allowed the company to establish a very strong foothold in a number of industries, ranging from the defense industry, utilities, government, telecom, and telecom naturally given its primary presence and core capabilities in communication services and video software services. So let's start by taking a look at some of the historic financials of Enghouse Systems. And as you can see, I'm actually using TradingView for my data sourcing for my data sourcing. And in TradingView you can just get a snapshot of the financial data and a number of other technical parameters in a graphical format. But if you take a deep dive into the financials, you can actually check out a number of details within their financial statements to their statistics and a number of other factors. So we'll just start by looking at some of the company's financials over the past 5 to 7 years. And as you can clearly see, the company has grown its total revenues from around 325 million in 2017 to around 385 million in 2019. And although it reached a peak of around 500 million in 2020, and after that it kind of normalized over the coming years to around 460 million, and basically north of the 400 million range or the 450 million range, and it has sustained its levels at that zone ever since. We can also see that the company's quarterly performances have actually improved a lot during 2024, even despite the fact that 2023 was actually a very promising year for the company, in which it delivered significant revenue growth and earnings growth, and delivered an overall considerable financial expansion. But despite that, the company has actually been able to improve its performances from 2023 within the current year and the initial 3 quarters of 2024. And this is primarily seen through the fact that the company's net income, which is 18.13 million in the first quarter of 2024, is actually modestly but significantly higher than the net income of 17 million in the previous corresponding period, or the first quarter of the fiscal year 2023. And along similar lines, but along improved lines, the company's net income has actually grown to 19.9 million, which actually remains a considerable improvement from both the first quarter of 2024 as well as the previous corresponding period for this quarter, which will be the second quarter of 2023, in which the company recorded a net income of 12.5 million. So if we actually take a look down below, you can see that the company's net income during Q2 has grown by 59.33% on a year-on-year basis, of course. And continuing on this trend, the company has now grown its net income to around 20.5 million in the third quarter of 2024, which was actually the most recent quarter for the company. And it has actually also sustained a stable revenue growth trend during this period, or during the last 3 quarters, where the company has been able to grow its revenues by around 5 million each quarter in 2024. So this actually remains a very positive note for the company and the investors, actually, as you can gain a lot a higher degree of predictability of what the company is going to perform like in the future, given its recent financial track record and given the fact that the company is expected to sustain these performances as well as its operational growth. And you can kind of assume this by studying the industry scenario of software solutions in general as well as enterprise software solutions, which have started to provide a lot more utility and efficiency to a number of enterprises operating in a range of segments and in a range of industry, which is exactly what in-house has been able to do over these years, and has actually been able to build a very strong market reputation based on these utilities offered to their clients. And it provides a strong base for sustained revenue growth and overall financial expansion for the company. And in fact, the stability offered by the company over these years, as you can already see from the graphs as well as the figures, where the company has maintained consistent level of revenues even during market downturns. It kind of provides a lot of security and resilience into its financial performances as well as returns for the investors, and kind of wraps up the company's financials on a very positive note. The cash flows, of course, I mean, in this case, follow a very similar pattern to its overall financial performances and do not show any differences compared to the revenues or net incomes, and have actually grown in a very similar trend, both on an annual basis as well as a quarterly basis, although the quarterly cash flows have been a lot more impressive, as you can see in the graphic displayed on the screen. The company's balance sheet also remains very stable, as you can see on the screen, and it consistently has been growing over the years, which has resulted in an expansion from around 590 million of total assets in 2019 to about 783 million in 2023, which is actually a very strong growth rate for the company. And although the company's liabilities have also grown, the asset growth has clearly outpaced its debt or liability growth, and that actually decreases the leverage proportion in the company's balance sheet, and contributes to additional security for the investors or for the investment. And the recent quarters have kind of maintained the same trend, where the company has consistently expanded its asset base while the liability growth has been relatively slower. So these factors, when sometimes combined with the price action of the security over the past few years, provides a very strong insight of how the security can perform in the future. And if we look at some of the more top line factors of the company and the company's financial performances, which would be the company's revenues, its net earnings, its cash flows, its asset base, or its general financial position and capital health. And you can clearly see that the company remains in a far better position in 2023 as well as in 2024 so far compared to what it was in 2019. Although it is not on the same levels as it was in 2020, but the decline in the company's financial performance has not been as significant as the decline in its stock prices has been over the past few years, despite the company still maintaining a large part of its fundamental value as it did back in 2019 and 2020. And this, as a result, has actually led to a huge decline in the valuation ratios for the company, and actually this security in this case and many companies in this case present a very undervalued investment opportunity for the investors, as they usually have been able to, and in many cases they usually have been able to recover from a financial decline which for most companies was in 2020 during the COVID-19 pandemic. And even though they have recovered their revenues, their earnings, their cash flows, and their overall financial health and operational health over these years, the stock price does not always show the same recovery for these companies. And in these cases, investors should stay on a lookout, and they might just find a couple of promising investment opportunities from these companies. And as you can clearly see in the company statistics, valuation statistics, you can see that the company's price to earnings ratio, which was around 37 or about 30 for the past few years, and although it did decline in 2022 owing to significant improvement in financial performance as well as a major decline in stock prices, the company's valuation metrics still remain way below what it used to trade at historically. And as you can see, from 2017 to 2021, it was easily above an average. The PE ratio was above an average of 30x at least. So that provides a lot of confidence in the company's current valuation prospects, as we are getting offered a PE ratio of around 21.81x, so a significant discount to what the company has been trading at when it was performing well in the past. Although the company's financial performances in recent years and in 2023 and 2024 have been actually quite impressive, even in comparison to these historic years. So let's take a look at the company's dividend profile, and here actually I have our dividend coverage for the last week, in which we covered Enghouse Systems Limited. And if you want to find out more about this report, you can visit our website, and we are actually running an offer on our dividend reports of about 85% for an annual subscription. And with that subscription, you can take a look at some of our historic coverages for some promising dividend stocks, as well as staying up to date towards our future recommendations and reports for some promising dividend stocks over the coming year. So as you can see in this chart, the company has actually delivered a very strong growth in its dividend payments on an annual basis, as we can see that the company's annual dividends have grown from around 44 Canadian cents in 2019 to about 88 Canadian cents by 2023, and this actually around marks a 100% growth rate for the company's dividend payments over the past 5 years alone. And this has also, as a result, along with the decline in the stock prices over the past few years and since 2019 or 2020, resulted in a very high growth in the dividend yield for the shareholders over these years, which has actually grown from around 1.15% in 2019 to about 1.19% again in 2021 to all the way up to 2.44% in 2022 and 2.70% in 2023. And actually, if we take a look at the company's recent dividend history, the company has further grown its dividend payments from the second or third quarter of 2024, where it delivered another uplift of about 4 cents into its dividend payments from 22 cents to 26 cents, and the company's dividend payments have yet again grown in 2023, and the company now offers a very promising dividend yield of about 3.15%, which itself remains very higher than what it was over the past year, and actually encourages prospects for further dividend payment growth for the shareholders, which might increase the yield for investors who take an entry point into this investment at present. And based on, of course, the dividend payment growth and the strong yield offered by the security at present, it actually presents a very strong baseline for return generation for the investors. And although the dividend yield is not excessively high, it also showcases that the company maintains a focus towards its own operational growth and continues to support its own capital expenditures and investing cash outflows for its overall long-term growth approach, while also delivering a considerable amount of income or distributions to the investors, which itself keeps on growing each year. So even though Enghouse ticks a lot of check marks across a range of fundamental factors and has shown a considerable improvement in its financial performances as well as operational performances over these years, it's also important to take a look at what the company plans to do over the short term as well as the long term, as it kind of provides a guideline of what the investor should be expecting from the company's operations, and often provides a glimpse of whether investors should be getting ready for some sort of investment risks within the company, as certain economic situations or certain operational situations can often disrupt the company's financial growth in the short term. So uh, the company presentations as well as its guidance towards its coming financial performance is usually the ideal way to go in this regard, as it provides a very strong guideline over what the company can do over the coming year and what the company itself expects to do over the coming year. And here I've opened the company's in corporate presentation for the third quarter of 2024, which you can find under their investor relations section on their own website. And this presentation actually highlights a couple of important points of how the company has a very diversified base of offerings and a very diversified portfolio across a number of operating segments, from its network portfolio to its interactive portfolio to its transportation and public safety portfolio, all of which are very diversified segments and industries to cater, by the way. And despite this, the company actually continues to offer a number of solutions from fleet management, communication solutions, and payment solutions and safety solutions for the transportation industry, and likewise number of infrastructures and operational support solutions in its network portfolio. And in the same sense, call handling, video interaction, and contact center customer service solutions for its interactive portfolio, which essentially allows the company to offer a varied suite of software solutions to its clientele, which again reiterates the utility it offers to its clients and kind of highlights the operational strength or the revenue generating or recurring revenue base that the company stands to hold for the future, which actually provides a strong support to the company's revenue stability as well as revenue growth over the coming years. And we can also see that the company also maintains a significant acquisition strategy, as I've also mentioned before. And the company has iterated that its current economic factors, which might have to do with the rate cuts, which might allow the company to increase its proportion of borrowings to support increased capital expenditures and operational expansion. So, in that sense, the economic condition remains favorable for the company to increase its capital expenditures and support its short-term as well as long-term growth. And these are some of the acquisitions that the company has carried out over the coming years, over the past few years, which has actually allowed the company to deliver the operational expansion that we can witness from its financial performances. So, although this does not always provide a very detailed list of data or detailed list of analysis, detailed extent of analysis, but it usually helps you, look out, check out the company's corporate presentations or investor presentations, as it can at least provide a glimpse or a guideline of what we can expect from the company. So overall, these factors collectively showcase that Enghouse is a very promising yet very undervalued player in the software solution spaces. Its industry diversification remains amazing. Its financial growth over the past 5 years has been very good. Yet, we can also see that the company has been trading significantly below its trading price from a past compared to the past few years or 2019 or 2020, despite having delivered very extraordinary growth rates or extraordinary stability actually in its financial performances, while its growth rates have also been very decent, and over a longer time frame its earnings growth as well as its revenue growth has actually been very impressive and fruitful for the investors, as we've also observed through the dividend yield, which continues to grow for the investors, and the dividend payments also continue to grow for the investors.